Are you leaving your investments vulnerable to market downturns? We've seen a lot of those. So the protective put, well, this can be your safety net when it comes to risk management in the stock market. But why would you buy a protective put? And the answer lies in its ability to provide insurance for your investments. When you purchase a protective put option, you have the right to sell your shares at a predetermined price, known as the strike price, within a specified time frame. So this means that even if the stock price drops, you can still sell your shares for a profit or limit your losses. But like any strategy, there's costs, there's benefits that you got to think about. And they can provide a peace of mind, but they also come with a price tag. So you really want to weigh out the cost against the potential benefits that you personally will get, and evaluate whether this strategy is going to align with your goals and your risk tolerance. So you're going to purchase these as a means of safeguarding your portfolio against downside risk, right? Hedging strategy. Let's go through an example here so you can better understand how it would work. So let's say you have 200 shares of ABC stock and you purchased it at $50 per share. So to protect the downside risk, you buy a put option on ABC with a strike price of $45, and you're going to pay a premium of $3 per options contract. Now the price of ABC stock starts to go down, hits $30 a share. And without the protective put, your loss per share is $20. With 200 shares, it's $4,000. Now, the protective put, you have the right to sell at the strike price of $45. So your actual gain from exercising the put would be $3,000. That's the difference. Now, here are 3 key factors to consider when you're thinking about this. The first is hedging effectiveness. They are effective because they do provide downside protection. They allow you to sell your stocks at a predetermined price regardless of the current market price. Second factor, long-term versus short-term risk management. Protective puts are suitable for both. The third factor, protective put versus stop loss. The stop loss order will automatically sell your stocks at a specific price. Puts are going to be a little bit more flexible. They're going to allow you to benefit from potential upside while you're still limiting your downside risk. The market can drop, your stop loss gets triggered, you're out. But at least with the put option, you can still hold on if the price goes back up. Now, the pros of protected puts, obvious: downside protection, limit your losses, and they're flexible. But there's some cons. The cost of purchasing these, potential reduction in your potential profits, and the need for ongoing monitoring. And these are suitable for all investors of all levels. And it's important that you evaluate your objectives, your risk tolerance, your market volatility, portfolio diversification, and even if you even need downside protection when you're considering whether you're going to do this. Now, there's other strategies as well. There's some important factors to consider when you're comparing them. The puts, it's going to, again, provide downside protection. You're going to have to pay a premium for them. You got to weigh those factors. Now, an alternate to a protective put is a caller or a caller strategy. And that involves combining a long position in the underlying stock with the purchase of a protective put and the sale of a covered call. It's a mouthful. Now, this strategy is going to provide limited downside protection similar to the put, while also generating income from the sale of the covered call option that you sold. It's a bit more complex. You can reach out to Mike here at Netpicks. The email will be below. He's our options guru for these kind of things. To wrap it up, buying a protected put can be a pretty smart move for investors looking to mitigate their risk, protect investments. When you use this strategy, you're going to limit potential losses. You're going to provide yourself some downside protection, especially during volatile market conditions. And there's going to be costs associated, right? You're going to have to pay a premium for these. There's ways to offset that with the caller strategy we spoke about. For some of you, the benefits of protecting your investment far outweigh the expense that you're going to have to pay. It's really important still that you evaluate your investment goals and assess whether it aligns with your risk tolerance and your strategies. Everybody's different. There's no cookie cutter out there. Thanks for watching. If you need to know more about options, hook up Mike over at netpicks.com. Again, his email is below. We'll talk to you soon.